There's no doubt that if you invest at the wrong point in time, you could end up with less cash than you put in. In fact, if you invest in any random day in the stock market, let's take the S&P 500 as a good example, from all the way back in 1950 to 2020, in any given year, the average amount that the stock market goes into the red is 13.5% at some point. So let's put that into perspective. Although the stock market does go up over the long term, and most years it will give you positive returns, you've still got to put up with the fact that at any point, you could be looking at double-digit losses in your account, especially if you're a new investor. Now that's not a fun place to be in, and there are a lot of people out there right now who are looking at some losses a lot worse. You might have already heard this before, but we're currently in one of the worst starts to the stock market ever since 1939. In fact, with the S&P 500 down 14% so far, the Nasdaq down 21%, and the Dow Jones Index also down 10%. If you're a new investor, you're probably kicking yourself right now thinking, why the hell did I start investing this year? I could have literally chosen any other time in the market. Well look, don't panic, this is not that kind of video. I'm not going to put anyone off investing. In fact, I'm going to try and help put everything in context and take a look at the data with you from history to see if these really are extraordinary times or whether or not this is just another bump in the road. You see, this isn't the stock market's first rodeo, if you know what I'm saying. It's been doing this a lot longer than you or I have been alive. So let's go and find an answer to the question, should we start investing in during a stock market crash, or should we just wait? The stock market's kind of like playing that game Buckaroo. Remember the one where you've got to take it in turns, add bits of plastic onto this mule, but at any moment it could just kick all of its legs up and all of a sudden everything's thrown off in the air. You've got no idea when it's going to happen. You could have already put all your stuff on or just getting started before it's too late, and then bang, it's all gone.
Buckaroo for a buckarootin' good time.
That includes all of your gains, by the way, so you're going to have to start again. Sometimes the periods when the stock market is down can last a really long time, and other times they can be really short. It can be really misleading to look at some averages here. But look at these examples. You might have heard of the concept of the lost decade before. It's a name given to periods where over the course of 10 years, the value of the stock market does nothing. And we mean literally nothing. So it starts at the same price as it ends up. What this means that if you get really unlucky and put all of your money into a stock market index fund like the S&P 500, right at the worst point, you would make literally no money at all. And if we add in the effects of inflation, you'll end up losing a lot of money. There's been two lost decades that we can actually take a look back on in the S&P 500. Firstly, there was one from 1965 to 1978. Yeah, that's 13 years, but it doesn't sound as scary as a lost decade. And then there's a more recent one that's more people reference. That's just before the dot-com bubble burst in July 2000 up until January of 2013. During both of those periods, you gained nothing as an investor. Whether you threw all of your money in on the worst day or you just invested every month as you had been told by all of the experts, your investments would have delivered sweet nothing. In fact, you'd probably be annoyed at yourself because you had all of that money in the stock market when a savings account or even bonds would have given you a better return. It's not a nice place to be in. Another example that gets used is the Japanese stock market. Now, check this out. Back in 1989, the Japanese stock market actually had its peak, and even up until today, it still hasn't breached that peak. There's been no new all-time highs in more than 30 years. And sure, you would have got paid some dividends along the way, but that would have been pretty painful if you've invested all of your money during that bull market run. The stock market can do literally whatever it wants for as long as it wants. Remember that famous saying that the stock market can say irrational for longer than you can say solvent? Hello, future Toby editor here. If you are enjoying the video, could you do me a massive favour and hit that like button? Subscribe if you're enjoying the content, it really does help out small channels like mine. Anyway, let's get back to this video that I've been editing. So now we know that these events have happened in the past, this isn't the first stock market crash and it certainly won't be the last. We're still left asking the question if we should actually start investing during a time like this. First though, we need to be prepared. We can't invest if we only assume that things go in just one direction. We have to accept that there will be risk when we put money into the stock market. After all, when we buy a company, we are buying a very small part of that business, and sometimes business can be good and other times it can be bad. Looking at some more data, on average the stock market experiences downturns, corrections and crashes pretty frequently. Small corrections of around 5% have occurred on average 4.5 times a year since 1980. Larger corrections of 10% or more have actually happened every 1.2 years over the same timeframes. And finally, those big crashes, if we say 20% or more, have actually occurred every 5 to 6 years. Even the best investors get hit when the market goes down as well, so you're not alone if you've just started over the past couple of years. Warren Buffett reminded us also recently that there have been 3 times in history that Berkshire Hathaway, the company that he runs with Charlie Munger, had gone down by more than 50%. Can you imagine that? Losing more than half of your portfolio at any time. You need to make sure you turned off your phone for a while and probably deleted all of the investment apps, and definitely go for a long walk. Charlie Munger actually added to this point by saying that if you react badly to a 50% drop in the price of stocks you own, or it causes you some major headaches, then he reckons you shouldn't be a shareholder at all.
In fact, you can argue that if you're not willing to react with equanimity to a market price decline of 50% 2 or 3 times a century, you're not fit to be a common shareholder, and you deserve the mediocre result you're going to get.
That's pretty blunt, but then, do you see the point I'm getting towards? Basically, market crashes, drops and corrections, however you want to categorize them, happen all of the time. We've got no idea how long they'll last, how far down they'll take the market, or when they will come. We just know that they're going to be part of our investing journey, especially if we're in this for the long term. The longer we invest, the more likely that we're going to see the crash or a correction of some kind, so it really is just part of investing. As long as we know that going into it, we should be able to protect ourselves. Otherwise, it'd be like getting onto a roller coaster, thinking that all it does is gently take you up to have a nice view, without knowing that you're actually going to get dropped 100 feet straight down, a few loop-the-loops, a corkscrew, and then get wet at the end because some kid was sick in front of you. I'd say that's probably a fair assessment of the current stock market we're in. Anyway, you might want to bring a towel with you. Right, so now we're ready to jump on the roller coaster. We know it's going to be a bumpy ride. How do we make sure that we don't get thrown off and try to get off at the wrong point? Here's a couple of things that as a brand new investor you really need to know right now, and these apply regardless of the market conditions that we're in. Firstly, I know you've heard the phrase time in the markets beats timing the market. We've just seen from history that during lost decades, if we went all in at one point, we do have a chance to lose money. Now sure, those are exceptional, but you don't want to take that risk at all. I get it. However, if you extend the period of time out by more than 10 years, things start to look better even for those of us who have had the absolute worst timing of all. Let's run some of these numbers that shows what would have happened if we invest over 1 year all the way through to 20 years or more. I think this might give you some confidence. Over shorter time periods, you have a good chance to make great returns in any given year, but also pretty high chances of bad returns too. If we take the S&P 500 as our example, between 1973 and 2009, in any given year, we might have seen gains of up to 61% in a single year, or on the worst case, over a 40% loss. Now, that's a pretty big swing and probably not something you want to hear as an investor. Right then, keep expanding out your time horizons and think like a long-term investor, and things start to improve gradually. As you can see on this chart, the moment you push past the 10-year mark and get closer to 15 years invested, or even 20 years invested, there was no rolling time period when you could have lost money in the stock market. Even if you had the worst possible rolling 20-year period, you would have still returned 6.4% per year, which, although isn't great, it sure beats holding cash and not doing anything at all. Compare that with the best 20-year period of the time, and you get all the way up to 18% per year on average. Now that's a lot more like it. For argument's sake though, just average the two out. It's not like all of us are going to have the worst timing and not all of us have the best timing, and you get 12.2% per year. Now, I don't know about you, but if someone could guarantee me that as an average over the next 20 years, I would definitely take that right now. Time in the market well and truly beats trying to time the market. As much as your gut is telling you right now that you might end up making a bad decision. So now that we've concluded that long-term investing is a great help, what about deciding when to invest and how we do it? All of these models assume that you're just a robot and you can invest the same amount every time. We know in the real world that we can't always do this. There's plenty of things in life that we've got to work around. However, saying that, let me share some data and a great blog post by Nick Majuli from his website of Dollars and Data. This post is called Even God Can't Beat Dollar Cost Averaging. Here's a summary, but I'd highly recommend you go and read it for yourself. It's really interesting. In short, he argues that even if you had information about where the stock market dips were going to be, and you could invest exactly at the bottom of the market after new all-time highs, you still won't always be able to beat someone who just invests the same amount every month, regardless of the price. Let's just put that into perspective. He's saying that even if you had a magic lamp granting you the ultimate stock market wish of telling you where the bottom of the market was, you still don't always win. This graph shows during different periods in history, even when knowing where the dips were, you could only outperform 30% of the time. And this was only because of the huge dips from the Great Depression of the 1930s. Outside of that, a simple strategy of buying regularly over a long period of time beats it for the rest of the 70%. You have two things working for you here: compound interest and averaging. That money that you put in during the early years grows over a large amount of time, and also by averaging your cost, you smooth out those lows and highs while you basically go back and enjoy your life. Nick reminds us here toward the end of the piece that if you miss the bottom of the market by just 2 months, you lose 90% of the time. So even if you were really good and had that kind of insight into timing of the market, even then you still can't beat it. The only thing we can't control here, which is a reminder for all of us that we don't know what period we're in right now for the foreseeable future, we could be heading into another lost decade, we could be heading into a period of amazing returns, who knows, but we can't control that part. Over history, the best period of 40 years with $100 a month invested gave you $500,000, a huge amount of money. When compared that to the worst period of 40 years, we would have still ended up with $153,000. Still though, our investment overall was $48,000, so we're still in the green, and I'd still take that for sticking with the plan for all of those years. All we can do as mere mortals is keep investing over a long period of time, hopefully into a diverse set of investments. Right now, if anything, we know we aren't anywhere near the all-time highs we were set last year, so we're in some kind of a dip, but either way, if I was an investor brand new to doing this, I'd have no problem getting started. Just remember that you should expect it to be a rough ride, be prepared for more downturns, be ready to see your portfolio have lots of red in it, but don't get off the roller coaster when it's at the bottom. Firstly, because that's no fun at all, and secondly, because the ride on the way back up is usually a lot more fun and even more crazy than the dip itself. If you are looking to get started, I've done a complete beginner's guide to investing here. Feel free to watch that one video, especially if you're from the UK. Otherwise, if you know what you're doing, why not check out this other video where I look at the problem with buying and holding individual stocks for life. You might be surprised by some of the results. Anyway, don't forget to leave me a big like if you've enjoyed the video, subscribe for more, and as always, happy investing.